Welcome to Group 1 Mains, subject Indian Economy and Development. Today's topic Money and Banking. I welcome you all for this Group 1 Mains on Money and Banking under Paper 4 Indian Economy and Development. I am Dr. E. Pavani, subject expert from Department of Economics, Government City College, Hyderabad. So, under Money and Banking, the contents which we are going to cover in today's session are concept of money supply, Indian banking and non-banking financial institutions, banking sector reforms and credit regulation methods of Reserve Bank of India. Let us start with the money. Definition and functions of money. Money is a liquid asset used to facilitate transactions of value. It is a system of value that facilitates the exchange of goods in an economy. So, money is the most liquid asset, and money has the capacity of doing good to the economy as well as sometimes becoming even evil to the economy. It is very important to control the amount of money supply in the economic system, and for smooth functioning of the economic system and for the purpose of planned economic development, controlling money through the monetary policy is very essential. So, it is a system of value that facilitates the exchange of goods in an economy. Without money, we cannot think of exchanging goods and services in an economy. And there were several difficulties under barter system because of which we were not able to see proper exchange of goods and services in the economic system. So, it was the introduction of the money. With the evolution of the money, all such problems have come to an end. Coming to the definition and functions or functions of the money, money performs different types of functions. The most important ones are money serves as a medium of exchange between two people or two institutions for the purpose of doing different types of transactions. It also serves as the measure of value, where the value of commodities and services can be measured only with the help of the money. Under the barter system before the evolution of the money, measuring of the value of goods and services was a very big difficult task, which made even exchange or transactions quite difficult as well as sometimes even impossible also. Then store of value. Money is the only liquid asset which can be stored for the purpose of with its value, and the value of such money when stored is not going to get decayed or deteriorated. And the next one is basis of credit. Money also serves as the basis or the basic structure for the purpose of credit creation and for the purpose of lending credit to the needy people in the society or in the economy. It is a unit of account. All the accounts, business accounts or maybe the government accounts or the personal accounts, all such type of accounts are going to be maintained only in the form of money. That is, money facilitates as a unit of proper account maintenance for all business transactions, for even individuals also, even for the government as such. Standard of deferred payments. All the future payments to be made can be made easy only with the help of the money. So, these are some of the important functions of the money. If we come to the concept of money supply, money is demanded by different people in the economic system for the purpose of satisfying three important motives: transactions motive, precautionary motive and speculative motive. Depending upon the demand for money, it is the responsibility of the government to even control or provide the supply of money as according to the demand in the economic system. So, money supply includes all the currency and other liquid instruments in a country's economy on the data on the date measured. It includes a total stock of money, that is cash, coins and the balances in the form of deposits with the banks circulated in an economy. Money supply, another name for the money supply is money stock. Then if you see this flow chart, government comprises of in the form of central bank and treasuries provides money supply in the form of paper currencies and coins into the market, and this money which is supplied by the government, on one hand government acts as the supplier of the money, on the other hand after supplying the money to see that this supply of money is not going to interrupt the proper and a smooth functioning of the economy, also have to play the role of bank regulators. So, on one hand the government and in the form of central bank and treasuries supplies the money in the economy. On the other hand, to see that the supplied money is not going to distract the smooth functioning of the economic system also act as bank regulators. So they influence the money supply available to the public through changes in the monetary policy. Measures of money supply. This is an important economic parameter monitored and regulated constantly by the government, and it is frequently used as a measure to keep the amount of money in check in the economic system. The standard measures of money supply, which are popularly well known in all the countries of the world, starts from MO, and which is also called as monetary base, followed by M1, M2, M3 and M4. MO denotes the currency bills, the coins and the bank reserves in circulation. M1 money supply is also called as narrow money and includes coins and notes that are in circulation and other easily cash convertible money equivalents. If you take M2, M2 consists of most commonly accepted measure consisting of both M1 and marketable securities and less liquid deposits. So here MO is equal to currency notes plus coins plus bank reserves. This is also called as base money available in any economic system. M1 comprises of MO and demand deposits with the banks. M2 is equal to this M1 plus marketable securities and other less liquid deposits. If you take the M3 money supply is also called, this M3 money supply is also called as broad money and includes M2 component and money market funds like mutual funds, repurchase agreements, commercial papers, etc. M4 money supply, it comprises of M3 and all other least liquid assets usually outside the commercial banks. So M3 is equal to M2 plus money market funds, M4 is equal to M3 plus least liquid assets. This classification is most popular classification which is available in all the countries of the world, and every country depending upon the importance it is going to give either to M1 or M2 or M3 and M4. It is going to concentrate and frame monetary policies so as to control these different types of money supplies to see that the economy is going to function smoothly without any disturbances, or even if any kind of disturbances are going to take place, the government by utilizing these 4 measures of money supply is going to rectify such kind of disturbances through the implementation of the monetary policy. So M3 is equal to currency plus deposits with 2 years agreed maturity, redeemable deposits with 3 months notice, etc. M4 is cash outside the banks plus private sector retail banking, building society deposits and private sector certificates of deposits. So measures of money supply vary depending on the country. For example, if you take the United States of America, Federal Reserve focuses more on M1 and M2 for the purpose of monitoring a US economy. Any disturbances in the US economy are rectified by means of checking out the M1 and M2. But in England, the importance is given to M4, and in India, RBI focuses more on M3 for the purpose of monitoring Indian economy. So what are the determinants of the money supply? Money supply are determined by the high powered money, which include cash and its equivalent with the public and bank deposits, the level of commercial bank reserves and the cash reserve ratio maintained by the commercial banks, liquid cash held by the public. These are the 4 important determinants of the money supply. Then if you come to the case of India, what exactly are the compositions or the components of M1, M2, M3 and M4? If you take M1, M1 comprises of the entire currency with the public. Along with the currency with the public in the form of both paper notes and as well as coins, M1 also includes demand deposits with the banks comprising mostly of savings account and current account only, not the time deposits. If you take the second measure, that is M2, M2 comprises of M1, which is already been explained. Along with M1, savings deposits of post office savings banks are also included in M2. If you take the third money supply in India, that is M3, M3 comprises of M2, that is M1 is there and even M2 is there, and along with this M2, time deposits with the banking system is taken into consideration. That is, in India, while framing the monetary policy, government gives more importance or concentrates on this M3 money supply for the purpose of policy making in such a way that any kind of disturbance in the economic system caused either due to the expansion of the money supply or contraction of the money supply will be curtailed by proper policy framing by the government. If you take M4, M4 comprises of M3 plus post office savings. The recent trends in India pertaining to the money supply, monetarists believe that if there is an increase in the money supply, it leads to inflation, and it also leads to an upward growth, a positive upward growth in consumption as well as business investments. So, between 51 to 2023, M3, which is mostly considered or mostly sorted out as the best monetary projecting picture, averaged 43,671.79 billion Indian rupees in December 2022, with an all-time high of 2,18,593.58 billion Indian rupees and a record low of 20.57 billion Indian rupees in 1952. That is, M3 was recording at its lowest in 1952, and the highest accumulation of M3 or the maximum M3 was available in 2022. It was an all-time high. The currency held by the public during the time of the COVID situation increased by 8.2% since March 2022, and savings and current account deposits with the banks decreased by 8%, because during the time of the COVID, general public never had any kind of confidence on getting permanent income. There was great havoc in the society. The economic confidence of the economic agents, which include the households and the business firms and the government, was drastically at a very low place, because of which public always wanted to hold more amount of currency to meet the unforeseen health expenditures, and at the same time, for the purpose of meeting such health emergencies, they always withdrew the current account deposits and savings account deposits from the banks, and with this the amount of currency in the hands of the general public suddenly increased. Let us now talk about the Indian banking structure. Banks are the supportive pillars to the financial system of the country. Financial system is unimaginable without these banks. Banks are well known for the primary functions, that is accepting of the deposits from the public and giving of the loans. Second comes the secondary functions, where banks are known for issuing of checks and drafts, and even taking up all the economic transactions to be done by their customers. On behalf of their customers, they provide these functions. They also issue the travelers checks, and they issue drafts. All such kinds of functions are secondary functions. If you come to the modern times, the functions of the banks have changed a lot, providing ATMs and digital currency and electronic clearing system, net banking, digitalization, digital currency. All these come under the modern functions of the Indian banks. If you take up the history of banking in India, in 1720, the first joint stock bank in India was established as Bank of Bombay. In 1770, the Bank of Hindustan was the second one, and General Bank of Bengal and Bihar was established in 1773. Then we had the three presidency banks. First Presidency Bank, Bank of Bengal in 1806, Second Presidency Bank 1840, Third Presidency Banks 1843. Later on in 1921, the Imperial Bank was established by merging above three, and this Imperial Bank today has got transformed to State Bank of India. In 1935, the Reserve Bank of India, or the Mother Bank of India, or the Central Bank of the Indian economy was established. Then classification of the banks. Banks are classified into scheduled banks and non-scheduled banks. Scheduled banks are those which are included in the second schedule of Reserve Bank of India Act 1934. They comprise of commercial banks, regional banks, state cooperative banks and urban cooperative banks, and they have paid up capital and reserves of an aggregate value of more than 5 lakhs. If you come to the non-scheduled banks, they are not listed in the second schedule of Reserve Bank of India. They maintain cash reserve requirements by their own decision. That is, Reserve Bank of India is not going to make it mandatory for the non-scheduled banks to maintain the reserves. They have less than 5 lakh reserve capital. Then if you take the Indian banking structure, Indian banking structure has 5 different types of banks. First is central bank, that is the Reserve Bank of India. established in 1935, which controls the activities of all these banks and also is responsible for the framing and implementation of the monetary policy on behalf of the government of India. Then comes the commercial banks. Under commercial banks, we have the public sector banks. Public sector banks exclusively work under the government's rules and regulations, and the policies, programs initiated by the government are usually implemented through these public sector banks. Then we have the private sector banks, where the management and the establishment is totally under the purview of the private sector, but still they are managed by the Reserve Bank of India. That is, the private sector banks pertaining to the credit creation and all such kinds of things have to operate under the purview of the Reserve Bank of India. Then we have the foreign banks. After the economic reforms introduced in 1991, foreign banks were given a chance to open up in different parts of India by establishing branches. And we have the regional rural banks established in 1975 exclusively for the purpose of providing credit facilities to the rural areas, more prominently to agricultural sector as well as to the industrial sector, especially the small skilled kind of industries. Then we have the cooperative banks. We have urban cooperative banks and the rural cooperative banks. Urban cooperative banks, they fetch the credit needs of those urban areas which have more than 50,000 of population. Semi-urban areas are also met by the urban cooperatives, and rural cooperatives where the population is less than 50,000. Then we have the development banks, which exclusively are established for the purpose of development of different sectors of the economy. We have Industrial Development Bank of India, IDBI, then IFCI, Industrial Finance Corporation of India. Such kinds of banks are established only with the intention of increasing the development process of the country by providing credit facilities to the needy sections or needy sectors of the economy which needs development. And we have the specialized banks like Exim Bank is there, which is a specialist bank in exports and imports, and NABARD, which acts as the Reserve Bank of India, supervising the activities of all the other banks which are established in the rural areas or which are trying to provide credit facilities to the rural areas, especially agricultural sector. Then we have even the SIDBI also, which tries to finances the credit needs of the small scale industries. So next comes the non-banking structure in India. Non-banking financial institutions facilitate bank-related financial services but does not have banking licenses. Non-banking financial institutions comprise of heterogeneous groups, different types of institutions. These institutions first include these heterogeneous group of institutions. They cater to a wide range of financial requirements. First categorization of this heterogeneous group comprise of Exim Bank, NABARD, National Housing Bank, SIDBI, Industrial Investment Bank of India, which are the specialized financial institutions working under the regulation and supervision of Reserve Bank of India. Then we have the non-banking financial companies comprising of asset finance companies, investment companies, loan companies, infrastructure finance companies, core investment companies, infrastructure debt fund, microfinance institutions. Then primary dealers are also included under the non-banking financial institutions like the mutual funds, insurance companies, hedge funds, venture capital, merchant banking, vulture funds and leasing companies. So the non-banking structure of India comprises of the specialized institutions, next non-banking financial companies and the primary dealers. Then we will come to the third part, that is the banking sector reform. So far we have completed what are the concepts of money supply, and in India which money supply is taken into consideration for the formulation and implementation of the monetary policy. The second thing we have seen about the banking structure, what are the different types of banks, and apart from banking structure, non-banking structure and the other non-banking financial institutions are also covered. The next one is we have the banking sector reforms. So reforms were introduced in the banking sector for the purpose of improving the condition of the banking system in the context of economic liberalization and growing globalization. The main objective is to improve operations efficiency and improve banks' financial reliability to fulfill best standards of performance. So banking sector reforms of 1991, the most famous reforms, where the Narasimham was appointed as the chairperson of this committee. And Narasimham Committee on Banking Sector Reforms of 1991 has talked about the statutory liquidity ratio, cash reserve ratio, transparency of balance sheets, electronic fund transfer, special loan recovery tribunals, and banking ombudsman. If you can see all these recommendations which were done by the Narasimham Committee, government has accepted these recommendations, most of these recommendations, and have implemented these recommendations. All these 6 types of recommendations generally speak about making the banks customer friendly banks. They wanted to make the banking sector more transparent so as to gain the confidence of the general public and make the banking business a profitable business, where each and every Indian is going to be covered by the banking in the form of opening up of accounts in their banks. So, if you come to the statutory liquidity ratio, every bank has to maintain statutorily a part of its demand and deposits, time liabilities in the form of statutory liquidity ratio, which is going to be 20%. In the form of gold, cash, and unencumbered securities. And this cash reserve ratio, a part of the deposits have to be maintained in the form of cash as per the law of the Reserve Bank of India. This is the cash reserve ratio. Both the statutory liquidity ratio and cash reserve ratio were advocated to be brought down so that the banks are going to make more and more credit available to the general public. And whatever activities, the income and the expenditure balance sheets of the bank should be made transparent in the form of publication of these balance sheets regularly by the commercial banks for the information of the general public. Electronic fund transfer, where the transfer of the funds can be made electronically more and more easy and feasible, so that the cost is going to be reduced and time is saved. And special loan recovery tribunals were also to be established. Banking ombudsman, where now the customers were given an opportunity to report to this ombudsman pertaining to the dissatisfaction that they have received or they have been faced because of because certain services were not provided up to the mark by the banks. Then 1998, again Narasimham Committee on Banking Sector Reforms was appointed, and the Narasimham Committee, second Narasimham Committee, that is 1998, has recommended for minimum capital risk assets ratio to be increased to 9%. Entry of the banks into the capital market. Previously, banks were restricted only in the monetary market. Now, capital market is that market where banks can even indulge in giving of long-term loans and raising capital by issuing shares and debentures. Doubtful assets, that is substandard performance in 18 months, have to be reduced. Doubtful assets should be reduced in number. Non-performing assets have to be reduced. Bonds issue permission was given to the banks, and training in credit treasury and risk management was to be given to the banks. These are some of the important committees which have suggested so many reforms, starting from the Ghosh Committee of 1993 till Damodaran Committee of 2011 on different aspects which were supposed to improve the performance of the banking and make banking customer friendly. The contemporary banking reforms, significant paradigm shift in banking system, banks being moved from major lenders to industry and other prioritized sectors, major providers of credit cards, personal loans, vehicle loans and housing loans, private banks surpassing public sector banks as major lenders, transactions through e-banking, that is internet banking, e-wallets, mobile banking. Then contemporary banking sector reforms, NARCL, National Asset Reconstruction Company Limited, where it aims at construction of a bad bank dealing with the bad loans. Bad loans, those loans which are above 500 crore are called as bad loans, and for dealing and for recouping these loans, a bad bank has to be established under this. Then we have IDRCL, India Debt Resolution Company Limited. It manages the assets of NARCL with the help of market professionals. Then we have the contemporary banking sector reforms only. Digital rupee, where the central bank's digital currency RBI digital rupee was announced in Union Budget 2022-23, which serves as digital representation of India's legal currency. National Bank for Financing Infrastructure and Development was another. It finances multiple projects that are part of India's 6 trillion national monetization pipeline. Then we have the last part, that is credit regulation methods of Reserve Bank of India. Reserve Bank of India performs the most important function of supervising all the banking institutions and non-banking financial institutions which act as pillars on which Indian economy is raised. So, the most important function of the Reserve Bank of India happens to be the credit regulation. What is the importance of the credit control? For the purpose of obtaining stability in the internal price level, for the purpose of attaining stability in exchange rate, for stabilizing money market of a country, to eliminate business cycles, to maximize income, employment and output in a country, to meet the financial requirements of an economy during emergency or war, to help the economic growth of a country within a specified period of time, credit control is very essential, because if the money supply is more, it becomes an evil in the form of inflation, and if the money supply is less, again it becomes an evil in the form of deflation. So, during different times, it is the responsibility of the Reserve Bank of India to check this increased money supply and decreased money supply, so as to ensure smooth functioning of the economy and reducing disturbances on the part of the economy for the smooth production, consumption and exchange process. Reserve Bank of India plays an important role in controlling credit in the economic system by implementing different instruments and utilizing different methods. The methods and instruments of credit control are classified into two types: quantitative, which are also called as general methods; qualitative, which are also called as selective methods. Quantitative credit control methods aim at controlling the total quantity of credit. Qualitative or selective methods aim at controlling the utilization of the credit and even the distribution of the credit. Quantitative or general methods comprise of 4 subtypes. The first one, bank rate. Bank rate refers to the rate at which Reserve Bank of India gives loans to the commercial banks. This bank rate is utilized generally by the Reserve Bank of India either as a cheaper monetary policy or as a costlier or dear monetary policy. Under cheaper monetary policy, the bank rate is reduced, whereby the commercial banks are now allowed to give more and more loans to the general public. Under the dearer bank rate, dearer monetary policy, the bank rate is enhanced so as to take away the deposits from so as to discourage the commercial banks to take loans from the Reserve Bank of India. Then we have the open market operations. Open market operations where Reserve Bank of India openly comes to the money market and sells the securities and even bonds to the general public. If there is a huge money supply in the form of inflation in the economic system, Reserve Bank of India directly sells these securities in the open market operations and takes away the extra money from the hands of the general public. And when there is lesser money supply in the hands of the general public, it resells those bonds and securities in the same open market operation so as to increase money supply in the hands of the general public. Then we have the variable cash reserve ratio. Under this variable cash reserve ratio, the commercial banks have to maintain a part of their deposits in the form of cash reserves. So, this cash reserves have to be, this is called as variable cash reserve ratio. By increasing the cash reserve ratio, commercial banks are discouraged to give more credit to the general public, or by sometimes and vice versa. When there is more money in the hands of the general public, the Reserve Bank of India increases the cash reserve ratio. When the cash reserve ratio is increased, commercial banks in turn have to raise the reserve ratio, so that the capacity of the commercial banks in giving out loans to the general public will be reduced. Automatically, the money supply in the economy is going to be controlled. Statutory liquidity ratio, where out of the total time deposits, 20% minimum has to be maintained by all the banks in the form of gold, cash and unencumbered securities. And this statutory liquidity ratio also is utilized by the Reserve Bank of India as a quantitative measure to control credit. If we come to the qualitative or selective methods of credit control, rationing of the credit in providing credit facilities in the form of loans to the commercial banks, it starts doing rationing. Next is margin requirements. While providing loans, usually when we speak about the consumer loans and the electronic loans which are processed by the banks, the bank is not going to pay the entire loan amount. It is going to fix a margin. So the Reserve Bank of India sometimes enhances this margin so as to discourage the commercial banks in providing greater amounts of the loans and vice versa. Regulation of consumer credit, where the down payment rates have sometimes are going to be increased or sometimes may be decreased depending upon the requirement of the situation. Control through directives. If the commercial banks, since all the commercial banks come under the purview of the Reserve Bank of India, it is going to give directives to the commercial banks to follow certain rules and regulations while providing credit facilities to the general public. Publicity, very regularly through periodicals and publications, Reserve Bank of India gives information to the general public about the situation of credit in the general market. Moral suasion, it is also under this method, it is going to request the commercial banks for the purpose of accepting the proposal properly by the Reserve Bank of India so as to control the credit or sometimes increase the amount of credit in the economic system. And if the commercial banks are not going to follow the rules and regulations prescribed by the Reserve Bank of India, RBI has every right to take direct action where it can impose even penal interest also on the commercial banks which have raised loans under the bank rate from the Reserve Bank of India. With this, we have come to an end of the class or topic on money and banking. Let us just for 2 or 3 minutes check out the previous questions which were based on the today's topic. Analyze the strategy adopted by the Reserve Bank of India to control the trend of rising prices since COVID-19. So soon after the COVID-19, when the supply of money has suddenly increased in the hands of the public, mainly because they have reduced their discretionary spending, that is speculative spending on one hand, and secondly they have converted all their savings accounts as well as current accounts into the liquid cash to meet the unforeseen medical emergencies. So analyze the strategy adopted by the RBI to control this trending of soon after this. The prices in the market generally started rising. The inflationary spiral has started showing a positive trend. So what is the strategy that is adopted by the Reserve Bank of India to control this trend is the first question. Second is explain the need for the emergence of regional rural banks and discuss the problems faced by them and the corresponding revisions that were made. So regional rural banks have been established for the purpose of providing credit facilities to the agricultural sector and small scale industries prevailing in the rural areas. So in spite of providing so much of credit through the regional rural banks, still the condition of the agricultural farmers and even the small scale industrial sector is not satisfactory. So what are the problems which are faced by them is being asked in this particular question. If you come to state the measures initiated by the Reserve Bank of India to regulate credit disbursed by the non-banking financial institutions. Fourth is explain the structure of the banking. Next, critically examine the role of Reserve Bank of India in credit control, where we have to write or talk about the quantitative credit control measures and the qualitative credit control measures followed and implemented by the Reserve Bank of India to control credit. Explain the important impact of economic reforms in the banking sector. After economic reforms are introduced, private banks have come and they are playing an important role in the banking system of India. And secondly, because of the introduction of digitalization, everything has become paper free and everything is being done on in the form of net banking and electronic banking. So this is the impact that student is expected to talk about after the introduction of the reforms in the banking sector. Private banking is favorably preferred over public sector banking. Critically justify this statement, elucidate the role of banking in economic development of India, explain the role of banking in the process of financial inclusion in India, because whatever policy the government frames for the betterment of the lower sections of the society, such kind of policies are implemented only by means of the public sector banks. With this, we come to the end of today's topic on money and banking. This is Dr. E. Pavani signing off for today. To meet you in the next class about Indian planning and Niti Aayog. Thank you.